Cast is now starting. All attendees are in listen-only mode.
Hi, good morning, folks. Hope you're all able to hear me. I'm going to unmute you, and then you can mute yourself. We're just waiting for some of the attendees to join in, and then we'll get started with the class. Yeah, Deepika, you have your hand raised. You can. Okay, I'm going to. I think you're self-muted. No, you're also. I'm also muted. You. I'll just unmute you. Okay. Um, Jessica, you have a question?
Jessica, you have a question?
I'm sorry, I don't have a question. I just looked up everything.
Jessica, your question was how
Jessica,
long
your
would the
question was
session
how
be
long would
for?
the session be for?
Yeah.
So it goes
So
on
it
till 10:30,
goes on
maybe
till
slightly
10:30, maybe slightly
more,
more,
depending on how much I'm
depending
able
on
to
how
cover.
much I'm able to cover.
Okay. So
Okay.
this is
So this is
the Indian time, right?
Indian time, right?
The agenda is
The
we'll be
agenda
doing
is we'll be
completing
doing
Reg 3, which we
completing Reg
started
3, which we
last
started
class.
last class.
It will be Reg 3 wrap up
The
and a
Reg
Reg
3 wrap up
4.
and the Reg 4.
Hopefully I can do up
Hopefully I
till
can do up
partnerships,
till
but let's see.
partnerships, but let's see.
Okay. My
My
system is
system is
echoing.
echoing.
I don't know why.
I don't know why.
Yeah.
Yeah.
I don't know, but does
I don't know,
anybody
but
else hear your
anybody
voice?
else the voice? My sister
From here.
from here.
Maybe Jessica, you have
Maybe
it logged
Jessica,
in
you have
two
it logged
systems,
in
maybe on
two
your phone
systems,
as well
your
as
phone as well as
laptop. Just check
laptop.
So
Check
my phone is
my
not like
phone is not like.
I'm just using
I'm just
everything on my
using everything on
laptop.
my laptop,
And it says
and it
computer
says
audio
computer
on the
audio
top.
on the top.
It says everything is
It says
echoing.
everything
So
is echoing.
I can't hear everything
I can't hear
clearly.
So
everything
even
clearly.
Avni is saying it's
Even
echoing.
Avni is saying it's echoing.
Let me just check from
Let
my
me
side.
just check from my side.
I can hear my own one. Can all of you mute
Can
yourself?
all of you mute yourself?
Yeah. Okay.
Hello, hello. Okay, now tell me, now that all attendees are on mute, now tell me if there is an echo. If you guys have an echo, and if you still hear an echo, either you can type. Okay, so now it's clear. But when somebody is speaking, it's echoing. There is disturbance. How is it now? I don't have your name. Whoever is typing, that voice is not clear and there's disturbance. Okay. Somebody is offline and yet able to type. I'm surprised. How does it happen? Um, the guys who are were muted by as organizer, I've unmuted you folks, so you can mute yourself if for better clarity. Vaibhav Kapil, it shows as if you're offline. I'm not sure if you are online. Deepa, you can mute yourself. I've unmuted you. Um, yeah, hopefully we will get over this echo issue while the presentation is get going. But as of now, you guys are muted. Um, I've self-muted. I've unmuted you, all of you as an organizer. So you can unmute yourself and speak whenever you have a question or an issue. Okay, guys, we'll get started with the session. Everybody else I was able to unmute except for Vaibhav Kapil, which shows as he's offline. So Jessica, you can mute yourself just so we can.
Okay.
Divyesh, I've unmuted you. You can mute yourself. Okay, guys. So everybody new who is joining in, I'll as we progress, I will unmute them as well. Okay. So in the last class, we did look at Reg 3, which is C corporations until deductions. I'm just going to go through like a brief summary of it, maybe about 5 minutes or so until other attendees join in. And then we can, start from the remaining portion of Reg. I'm just going to open up the PDF file. Yeah. Okay. So hope all of you are able to see my screen. So we started with the formation of, we actually did a brief overview of what is the form 1120, where Yeah, we did a brief overview of Form 1120 where you looked at what goes on page one and how who must file a Form 1120, when do you need to file it, the when actually right now it's not very important because it's not tested in the tax return, but who must file a Form 1040, all C corporations must file. There is also a consolidated tax return filing option where, unlike for gap, here you need to have 80% or more control to consolidate. We also saw that most C corporations file on accrual basis, though there are certain exceptions where cash basis filing is allowed. Under formation of C corporations, we saw that generally it's called a Section 351 transaction, where generally the issuance of stock in exchange for cash is a non-taxable transaction. And when is it non-taxable? When the issuers of the contributors of cash and property receive 80% or more control from the corporation, then it is a non-taxable transaction. The shareholders basis in the stock is equal to the cash contributed or the basis of the property contributed, right? And the corporation receives the same basis in this property as that of the shareholder. We also saw that there were certain exceptions to this. One where the shareholders don't receive 80% control, or two when hello. Or two, when the mortgage contributed is say more than the asset contributed, or if there is boot that is involved in addition to the stock that is received. So these are some of the possibilities or situations in which the shareholder will have to recognize a gain in addition to receiving the stock. Um, so we also looked at that certain reorganizations in general, such as mergers or acquisitions, they are non-taxable. Again, there are when we do at the end of the C Corp chapter, we look at the various different types of reorganizations which are non-taxable. But we just get a brief overview at the formation of C corporations, where we understand that as long as you receive more than 80% control, it's a non-taxable transaction. We also looked at the income items. Generally, during the class, I have tried to draw parallel to what we did in individuals. Maybe said, whatever is income at the individual level, it works similarly for C corporations. Dividends, like for example, dividends is also income. Interest, rents, and royalties received in advance is income to the C corporation now, similar to how we did for individuals. That is, even if the C corp is on accrual basis, anything that's received in advance is recorded as income now. I think somebody has unmuted themselves. There's probably some disturbance because of that. Okay. All right. So now there is none. We also looked at capital gains and losses. One thing is the losses were treated differently from individuals. We said we don't get any excess losses. The losses are either carried back or carried forward, 3 years or carried forward 5 years. And the capital gains don't receive any special capital gains tax rate like how we have for individuals. It's treated as ordinary income. Net gains from sale of business property here too. This is similar to what you learned in Reg 2, where we studied that the business property is classified as a section 1231 property that is held and used in business for more than 1 year. If you have and then within that you had classifications for personal property and real property. Personal property was section 1245 property, and real was section 1250 property. In both cases, if you had previously deducted any depreciation, that such depreciation had to be recaptured as ordinary income, and the remaining would be your capital gain. And the best thing about section 1231 was that all gains were capital gains and all losses were ordinary losses. Going forward, we also looked at deductions. We realized that okay, folks, are you is there any disturbance in my voice quality? Because I got a notification here. Hello. Is it it's not bad. Okay. Okay. Fine. Great. So then we looked at deductions, where we studied, okay, there are ordinary and necessary deductions that you can take, again, like what we did in, when you're as a shareholder, as a sole proprietor, all this income that is ordinary and necessary for you is deducted on your Schedule C. Likewise, it is for C Corp. I mean, like for example, when C Corp gets 50% of meals and entertainment, there are certain non-deductibles, of course, such as fines and penalties or federal income taxes paid. There is also any estimates are non-deductible for C corporations, such as bad debt or warranty expenses. These are not allowed as a deduction. Certain items had special limitations. We had DPAD, again similar to what we studied in individuals. Charitable contributions, it said that they could take only 10% of adjusted taxable income, which is basically, and it also didn't allow for any special deductions like NOL or DPAD or capital loss or NOL carryback into in computing this charitable deduction. It was basically 10% of adjusted taxable income, which means that your ordinary income less ordinary deductions was the threshold basis which we would calculate the charitable contributions. We also had studied about net operating loss carryover. The rules are same. It's 2 years carry back or 20 years carry forward. The computation did not include the prior year carry back or carry forward, but it did allow for dividend received deduction, which is a special deduction. So coming to dividend received deduction, we saw that depending upon your holding, that is, if it is 70% holding, then you had a 20. If it were a holding of 20%, then you would get about a 70% deduction. If you held anywhere between 20% to 80%, then you would get an 80% dividend received deduction. And if your holdings were more than 100%, then it would be a consolidation scenario, and you would get 100% deduction. So this is on dividends received from your affiliate corporations, right? So if you have holdings up to 20%, you got a 70% deduction. There were some calculations here. How was the dividend received deduction calculated? It was based on the lesser of the taxable dividend or actual taxable income or actual dividends received. Now you would stick to actual dividends received if the deduction actually led to an NOL situation. So which means that, say the company is performing really bad and dividend received deduction would generate an NOL for them, then you would go calculate the deduction only on the actual dividend income rather than the lesser taxable income. So that is as far as all the so far what we had studied. Any questions here before we move on to the next topic? Okay. So let me go on to this. All right. So the next part which we're studying here about is your reconciliation of taxable income with book income, and I want you guys to look at your schedule, your form 1120, and go to page number R312, which basically shows your schedule M1, and I'm also going to pull that up here. Okay, so your schedule M1 is basically your reconciliation of your book income with your tax income. It generally starts, as you can see, with your net income per books and ends with the taxable income on page 1 or line 28. And if you can just flip your pages, you will see that the line 28 is basically your taxable income before any special deductions. So it says over there on line 28, taxable income before NOL and special deductions. So that is what you have to match to or arrive to when you're reconciling your book income with your income per tax return. Now, why would you reconcile? We reconcile because there are book tax differences, some of which are permanent and some of which are timing differences, and therefore only for a short period of time. When we look at the form, you can see here the differences. Like for example, federal income tax per books. So federal income tax per books is not a deduction for tax purposes, and therefore you have to add it back. Excess of capital loss over capital gains. Again, for tax purposes, we take capital losses only up till capital gains. Therefore, anything excess that you have taken in your books must be added back. There are certain other incomes that are subject to tax but not recorded on books. This could be something based on timing differences, maybe installment sales, or maybe your your contracts, your long-term construction contracts related income. But such income would be added back. Expenses recorded on books this year but not deducted on this return. Again, depreciation, there may be some book related depreciation that we've not taken in tax but have taken in book, then that needs to be added back. Charitable contributions, right? Think about it, only 10% of it is allowed, 10% of ATI is allowed as a deduction on your tax return. So excess, whatever remains in the books, needs to be added back. Travel and entertainment. So travel is allowed, but look at entertainment, right? We get only 50% of it, so the remaining 50% gets added back. There are also other things like fines and penalties, that is disallowed for tax purposes but must be added back. On the right hand side, we can see here it says, okay, income recorded on book this year but not included on the tax return. So then these are probably subtractions, right? For example, tax exempt income. Tax exempt interest is obviously it's not taxable for tax purposes, and therefore we need to subtract it from the book income to arrive at our taxable income. Deductions on this return not charged against book income this year. Depreciation. A lot of times depreciation will be filled up here because our maker's depreciation is more of an accelerated depreciation when compared to the book depreciation. Therefore, there's additional depreciation that is deducted for book purposes, and therefore it must be subtracted here. Charitable contributions. Remember, charitable contributions we said can be carried forward up to 5 years. So you may have, for example, in your 2017 books, you may have taken the entire charity, but for tax purposes it was disallowed because of the limitation, and there is a carry forward. This year you don't have any charity on your books, but then you have this carry forward which will reduce your tax liability. So that will show up over here as a charitable contribution deduction. So that makes up your your schedule M1, which is basically reconciling your book income to your tax income. There is also schedule M2. Schedule M2 is basically a reconciliation of your retained earnings, and this is where we would record any distributions that that are made to the shareholders, in the form of dividends or stock or property. That would go in here in schedule M2. Now there is also something known as a schedule M3. So schedule M3 is basically filed by very large corporations which have greater than 10 million in assets. Now this is because obviously they have more disclosure requirements, and they are required to file a schedule M3. They no longer can file an M1. It's basically an expanded version of schedule M1 with a lot more details on determining how you come up with all the additions and subtractions that goes in schedule M1, for example, from line 2 to line 9. A lot more detailed calculations over there. Any questions here, guys? So what we'll do now is actually there is one simulation question that is there at the back of the textbook. So we'll do that so the schedule M1 concept becomes thorough. Let me open that up. Okay, there you go. And I wish I could actually write on this PDF, so things would have been easier. But in any case, so let's look at this question. It's an aviator corporation which provides the following information for 2013. You can see they've given you net income per books or after tax, which is basically that is where you would start from, right? Your line 1 would carry the 310,000. Then they've given you other items, which federal income tax liability, retained earnings, interest income from municipal bonds, cash dividends paid to shareholders, life insurance proceeds on death of key employee, premiums paid on life policy insuring aviators precedent, excess of capital loss over capital gains, employee entertainment expenses, dividend income, makers depreciation, and retained earnings at the end of the year. So you are required to prepare a Schedule M1 for the year 2013. Okay. So guys, you can unmute yourself and we can solve this problem together. I'm going to set my Excel up in the meanwhile. I'm just going to fill this up and meanwhile try to solve this, guys, maybe on your own, and then we can do it together. Just give me about a couple of minutes while I fill this up. All right. So who's going to help me fill this up? Guys, please unmute yourself. What goes into the first line? Net income per books. 310,000, yes. $310,000. Okay. Next, federal income tax per books, that's given
104,150.
Yes, 104,150. Then, do we have any excess capital loss over capital gains?
7,000.
7,000. Okay. Is there any income subject to tax but not recorded on books this year?
Not really.
Not really, right? We don't have anything. We have something else that is income recorded on books but not subject to tax, right? That comes in a different place. Okay. How about expenses recorded on books this year but not deducted on this return? Do we have any depreciation?
No.
Any charitable contributions?
There's something employee entertainment expense.
Employee entertainment expense, yes. So how much of that would we take?
50%.
50%, right? So 50% of $6,000. So 3,000 would be your add back, right? Because for tax purposes, you get only 3,000. Is there anything else that I should include?
The premium paid on policy insuring.
Yes, yes. So we have this premium paid on policy insuring aviators precedent, $5,000. So this is a key employee insurance, and therefore that is a not allowed deduction for tax purposes. So I'm just going to put other. So key employee insurance, and that is going to be 5,000.
5,000.
Yeah. So now I think that's it over here. So now we can add up the lines 1 to 5. Alright. So now coming to the right hand side of the table, right, where it says income recorded on books this year but not included in the tax return, tax exempt interest. We have that. How much is that? $20,000, right? Okay. Do we have anything else? That's income for books but not for tax.
I think the life insurance proceeds.
Life insurance proceeds, yes, of key employee. $100,000, yes. Do we have any deductions on the return not charged against book income? Depreciation. We have that?
9,000.
Yes, so
Yeah,
that is,
9,000.
yes, maker's depreciation in excess of straight line. So that would come here. Do we have any charitable contributions carry forward?
No.
No. So let's summarize this, line 7 to 8. So that's 129,000. And what is your income on line 28? So that is going to be sum of this less this, $300,150. Any doubts here, guys? So this is what will go on line 21. I'm sorry, line 28 of your form 1120. Schedule M1 is an important concept. Shelley wants to be unmuted once. Shelley, now you're self-muted. You can speak.
Jayashri, can you explain the concept of depreciation here?
Depreciation. Okay. So, see, generally, depreciation for book purposes is straight line depreciation. For tax purposes, we have makers accelerated depreciation. So, because the the tax depreciation is more than the book depreciation, it is an additional deduction which would reduce your taxable income. So that's why what we are doing is, if you look at line number 7 to 8, we are subtracting from this number, which is basically, see, if you look at this pattern here, we started with a net income per books of $310,000. Then we gradually added items which are taxed now, but not taxed in the books. So then our income increased to 429,150. Then we accounted for items which are deducted for tax purposes but not for book. And one of those is this depreciation, because there is excess depreciation for tax purposes, which reduces your book income. And here we are arriving at the taxable income. Is that clear, Shaili?
Yes, okay.
Okay, great.
Jayashree, I have one question.
Yeah.
Did we not deduct the dividend income that there is?
Okay.
There's a $10,000 dividend income, so 70% of it we should.
Good question. So now go back to your form 1120. Okay. Go to the page number. So in form 1120, page number R38, look at line 28. What does it say? Taxable income before NOL and special deductions. So your DRD that you're talking about comes after this.
Line item. All right.
Okay. So that's what we are arriving at. Okay. So that is income though. Now the 310,000 includes the $10,000 dividend income, and we are not touching that. Yes, it is also taxable, but the deduction comes after this. More questions on this? Again, important concept, guys. Could be tested in the exam as MCQ or even simulation. So let me move on. Okay. In calculating tax, again, folks who are not speaking maybe can unmute. I'm sorry, mute yourself so that everybody is able to hear clearly. So the federal tax rates for C corporation ranges from 15% to 35%, though the new Trump tax law has come up with a lot of change this year. And this is something that we are not going to worry about now, but good to know kind of thing. They also have foreign tax credit, which is similar to what we see for individuals. The excess is carried back 1 year and forward 10 years. Let me see, somebody is still unmuted. Okay, so noise is gone now. And then C corporations are also subject to alternative minimum tax. Now the computation of alternative minimum tax, again, let's compare this with individuals and see what is different here. Here we start with regular taxable income. We have adjustments and preferences, the lid and the dip. We'll talk about that. We've already did this when we did individuals, but they're the same as how we had for them. Individuals, we filed a form 6251 for AMT. And here the computation, they have the same type of adjustments and preferences, but they have something new which we don't see in individuals, is basically the adjusted current earnings, where an additional add back happens or some subtractions, and the mnemonic for that is sale. 75% of certain items are added back or subtracted. This is done before we arrive at the alternative minimum taxable income. Just like individuals, C corporations also have certain exemptions which would reduce the AMTI. To arrive at the AMT tax base, they have a tax rate which is 20%, flat 20%. Unlike individuals, which we had a tiered rate, slightly tiered, we had 26 and 28, depending upon your alternative minimum taxable income. But here there's a flat rate of 20%. Then you arrive at your tentative AMT. If it is greater than your regular taxes, then you end up paying the AMT rate. So let's look at this. So the adjustments and the preferences, the lid, again some slight revision, jogging of your memory here, where L stands for long-term construction contract. For AMT purposes, only percentage of completion method is allowed, and therefore if you have done a completed contract method, then there is an add back over here. Installment sales, it is not allowed for dealer in property sales, so they have to add back their income. Depreciation of post 1986 real or personal property. Here what they mean is, for real property, if you've taken an accelerated depreciation, then for tax purposes it's only straight line, and therefore they must be add back. For personal property, generally under makers, you have a 200% double declining balance method, whereas for AMT it's only 150%, and therefore there is an add back. When we look at preferences, we have the mnemonic dip, where again D here is depreciation on pre-1987 real or personal property, where they don't make any distinction between real and personal, but they are saying that there must only be a straight line depreciation, and therefore there is add back. And there's something that I want you guys to make note of here. Your adjustments can be positive or negative, right? Whereas your preferences are always a positive add back. Interest on private activity bonds. Again, municipal bond interest generally non-taxable for regular tax purposes, but if the purpose of raising such bond is for private activity, then it must be added back for AMT purposes. When we look at, and P here stands for percentage depletion. Again, a depletion, there are two methods. There is a cost depletion method and a percentage depletion method. Cost depletion method does not deplete the value of that resource below zero, but a percentage depletion, which is based on income, allows you to deplete even if the value has become zero. So percentage depletion is allowed for regular tax purposes, whereas cost depletion is allowed for AMT, and therefore there will be an add back. Now, there is also known as something known as an adjusted current earnings, and actually this will be better understood maybe if we look at the AMT form itself. So let me just take you to that page. Okay. Oh, actually, something that I missed earlier. One second. So this page in your book, page R330, this kind of is a very good summary of all the permanent and temporary differences which will lead to the Schedule M1, or which actually are the items that get filled up in the Schedule M1 book tax reconciliation. And as pointed out over here, when you're doing FAR, deferred taxes, again that also is based on the concept of book tax differences. So you want to compare that when you're studying that, revisit REG and go through this page and try to draw parallels so you can understand both of them, how it works. Okay, so let's look at this form, right? So it is form 4626 here. And you can see we start with the taxable income before NOL. There are these adjustments and earnings, and then you arrive at ACE. To this ACE, right, you can see here pre-adjusted alternative minimum taxable income. So we start with taxable income, we calculate the adjustments and preferences, and on line 3 we arrive at pre-adjusted minimum taxable income. So to this we make these ACE adjustments, which is 75% of certain items. And let's look at these items. So what are they saying here? Sale consists of S, where S is 70% DRD, which is basically the dividend received deduction, where if you took a 70% DRD deduction, they are saying a portion of that, which is basically 75% of that amount, must be added back to arrive at your ACE. So again, it is not the 80 or the 100%, but only applies to the 70% folks. There is also ACE depreciation adjustment. Again, this is add back or subtraction of differences between AMT depreciation and ACE depreciation. Again, not something that ACE depreciation is something that not really tested in the for your CPA exam purposes, so we won't go there. But just understand the calculation is something that we don't go there. But they understand that there's also an ACE depreciation adjustment, which could be either added or subtracted 75% of that. Then interest on municipal bonds. So what is this? In the preference item, we added back interest on private activity bond. Here we are adding back the interest on municipal bond. So basically, if for example the interest you paid on municipal bonds consists of both private activity and non-private activity, your private activity would be added back through your preference item, your non-private activity would be added back through this ACE adjustment. Of course, 75% of it would be added back. Then life insurance proceeds on death of key employee. This was never taxable for regular tax purposes, but it is an ACE adjustment, and 75% of that must be added back. So there is an example in the book that I will take you to understand this. And there is also certain organizational cost amortization deductions, which are also, of course, added back. So let's look at this example, right? Assume a corporation has regular taxable income of 600,000, and the only item it has that are relevant to the computation of AMTI are interest on general obligation municipal bond of $100,000 and interest on private activity municipal bond of 200,000. So the example that I was referring to, right? So determine AMTI, the following calculation is made. So you start with your regular taxable income, 600,000. To that, you have a preference item adjustment, right, which is your private activity bond. You add $200,000 fully, and then your AMTI or pre-ACE adjustment, pre-ACE AMTI is $800,000. Then you make your ACE adjustment. ACE adjustment is basically your, the I of sale, where we're looking at interest on general municipal obligation interest, and that is basically 75% of that amount, which is $75,000, and then you arrive at your AMTI, which is $875,000. Any doubts so far? Okay, let's go back. Few other concepts in AMT. Alternative tax NOL deduction. So they also have an NOL. AMT is a parallel tax system. It also has its own NOL computation. It has the same carry back and carry forward rules as regular NOL. It's calculated as 90% of the AMTI without regard to any prior year carrybacks or carry forwards and DPAD. AMT exemption. And the reason I put this formula here is because this doesn't change and it gets tested in the tax return. So it's always $40,000 minus 25% of your AMTI before exemption, less $150,000. So just keep this in mind. Generally we're not required to remember any of these things, but this is something that does not change, so you'll have to remember. AMT tax rate is a flat 20%. As discussed. They also have tax credits like foreign tax credit, and there is also a minimum tax credit, which is basically credit for prior AMT. And what does this arise? This arises out of temporary differences where maybe you are paying your AMT tax ahead of time when compared to the regular tax. Then in such cases, when you against your regular taxes in future years, you get a credit because you don't want to pay twice for this. So you get a credit for the AMT that you have paid before. This credit, of course, applies only to regular tax and not the future AMT. It's a credit for regular tax. And so this is your AMT. Any doubts here? Okay. Moving forward. There are penalty taxes. Now, again, if you look at Form 1040, right, we had some additional taxes that were paid in addition to the regular and the AMT that was computed. Like, for example, for IRA, if you had withdrawn before the withdrawal time period, then you had to pay a penalty. So likewise, C corporations also have penalty taxes. First category is actually called the accumulated earnings tax. Now this is a tax that is imposed by the IRS, which means that it's not calculated on the tax return, but after the C corporation files the tax return, the IRS may assess an additional tax and levy it on the corporation. So it is imposed by the IRS for what? For excess accumulation of earnings. The tax is 20% of undistributed income, and it is subject to the following limitations. That is, there is a minimum or deduction of $250,000 for regular corporations or $150,000 for personal service corporations. It can be reduced for the actual dividends paid or constructive dividend. It can be reduced for all capital losses incurred during the year and charitable payments or federal taxes owed, and it can be reduced your undistributed earnings for any accumulation that you have made for which there is a reasonable purpose. So if you can look at the pattern, right? Right, so from your accumulated earnings which remains undistributed, apart from this basic deduction, that is you can accumulate up to 250K for regular corporations and 150K for personal corporation. The others, especially the actual dividends or constructive dividend or capital losses, charitable payment, federal taxes, these are obligations of the corporation which have to be incurred, and they are not available for distribution. The capital losses, this is actual losses incurred. They're not available for distribution, so they have to be reduced. Charitable payments, federal taxes owed, these are obligations that have to be incurred, and therefore they reduce your undistributed earnings. And then after having accounted for all of these, including accumulations for any reasonable needs, if you have any excess accumulated earnings, then on that there is a 20% tax that is calculated. So this is as far as accumulated earnings tax. There's also this personal holding companies tax, where personal holding companies are this is self-assessed on the form 1120 on a form called PH form. I believe that's a schedule PH, which is filed along with form 1120. What is a PHC? It's an entity with 5 or fewer shareholders who own more than 50% of the stock during the second half of the year, and 60% or more revenue is generated from passive sources. Then such companies are known as PHCs, and the tax on them is 20% if they do have such type of an income. Any questions till now? Okay. Going forward, so this is your two primary penalty taxes: your accumulated earnings tax and personal holding company tax. Then let's look at calculating. Okay, under calculating tax, there's still one more thing that we need to look at, which is underpayment penalties. So basically, if the corporation has underpaid when compared to the tax liability that it owes on the form 1120, then it must pay a penalty. Now, when is it computed? When your quarterly installments, estimated payments that you make are not sufficient to meet the tax liability. And when are the quarterly payments made? On the 4th, 6th, 9th, and the 12th month. And if you compare this for individuals, the 4th, 6th, and 9th of the year remains the same, but instead of 12th month, it comes on January of the following tax year. Can this be avoided? Yes, if your total underpayment is less than $500, or if the corporation pays 100% of the current year's tax liability as part of its estimates, or if it is a small corporation, it must pay the lesser of the 100% of current year liability or 100% of prior year tax liability. So if you underpay taxes, then basically be ready to pay the penalties. Let's move on. The next topic here is corporate earnings and distributions. Again, an important topic. If you look at corporate earnings, they're divided into two items, large items. One is CEP, consisting of current earnings and profits, and the other is AEP, consisting of accumulated earnings and profits. So this is your CEP is similar to net income. It determines a corporation's ability to pay dividends to the shareholders. Here, how do you arrive at CEP? You begin with taxable income, and then you make positive or negative adjustments. So the final number that you arrive at is almost close to your net income. Like if you look at the table that's given in the book, so look at that, start with the corporation's taxable income and then adjustments, add tax exempt income. So obviously this is like reverse of what you were doing in schedule M1. You add back your tax exempt income because it's income for book purposes, and it determines the corporation's ability to pay the dividends. Life insurance proceeds on death of key employee. Annual deductions, these are only tax deductions and not book deductions, so they needed to be added back. Dividend received deduction, refund of federal income taxes paid. So I mean, you have a lot of examples over here, but as I said, the objective here is to get back to the CEP, which is similar to net income. You start from taxable income and you arrive at the CEP. Now, what is AEP? It is basically the sum of all prior years' earnings and profits, or CEPs, in those years, similar to retained earnings in the book. How is AEP at the end of the year calculated? It is basically the AEP at the beginning of the year plus current year earnings and profits minus distributions from CEP and minus distributions from AEP would give you the AEP of the current year. And why are we showing distributions from CEP and AEP separately? And we'll see that in the following slide, that any distributions that are made by the corporation first comes out of CEP, and then only it is taken out of AEP. So corporate distributions, generally we know that distributions come in the form of dividends to the shareholders, right? So distributions are treated as follows: as taxable dividend income. How is it computed? Say the corporation is making a $10,000 distribution. How do we determine that all of that is dividend income? So it is computed as the greater of the CEP or the sum of AEP and CEP. We'll look at an example in the book and you will understand this. Will there be any non-taxable return of capital? So say after the CEP and the AEP has been exhausted, then to the extent of shareholder basis, it is a non-taxable return of capital. Will there be any taxable capital gain distributions? Yes, dividends in excess of all the E and P, which is basically your CEP and AEP, and shareholder basis would be treated as taxable capital gain distributions to the shareholder. Let's look at that example in the book to make this clear. Okay, so look at this. Assume a total dividends of $100 is paid out in each case below. Taxable dividend represents the higher of CEP or AEP. So let's look at this. Case 1, current E&P is $70, accumulated E&P is $30. Okay, now the dividend that's paid out is $100. So how much of this is actually dividend and return of capital? So remember, your dividend is basically the higher of CEP or sum of AEP and CEP. So CEP here is $70. The sum of AEP and CEP would be $40, which is lower. So which means your dividend income is $70, which is the higher CEP. $100 was paid out, so the remaining $30 is return of investment, non-taxable. Of course, here an assumption is made that the shareholder has enough basis to absorb this return of capital. Let's look at the next case. The CEP is $40, negative 40, AEP is 90. Sum of this is $50. Now, what is higher? Obviously, the sum of AEP and CEP, the $50 is higher, and therefore, your dividend income would be $50, and the remaining 50 is non-taxable return of capital. Let's look at case 3. The CEP is $30, AEP is $30. So if I look at it, the CEP 30 is lower than the sum of AEP and CEP, which is $60. Therefore, my dividend income would be the higher amount, $60, and the remaining 40 is non-taxable return of capital. Case 4, look at this. Your CEP is negative, your AEP is also negative, which means that I don't have any dividend to distribute. I cannot distribute from a negative CEP or AEP. Therefore, the entire amount would be a return of capital. Any doubts till now? Okay. All right, let's move on. So now, now if there is more than one dividend distribution during the year, so it's not necessarily that they just decide on one day and every year and distribute that time. There could be quarterly dividend distribution as well. And if your total distributions during the year exceeds the CEP, then there is a certain ordering that's followed. Obviously, as I said, your distributions first come out of CEP and then only out of AEP. So you allocate your total CEP on a pro rata basis to each distribution. Okay, there's a repeat here, but I think you can. And after you have exhausted your CEP, then you allocate your AEP in chronological order. I have an example here where, say, your AEP is $12,000 and your CEP is $18,000. Your dividends is $16,000 each, which was paid in March and November. And let me show the calculation here. Okay, so AEP is 12,000, your CEP is 18,000, dividend in total was 32,000, which was paid in 2 installments of 16,000 each, right? So this is your total distribution, 32,000 paid as 16 and 16. Now, as I said, you allocate from CEP on a pro rata basis. So there were 2 distributions that were made. So this 12,000 is divided into the 2 distributions. The AEP is allocated $6,000 each. And then once the CEP has been exhausted, then I allocate from AEP, which is $18,000 in chronological order. That is from the first distribution. So in the first distribution of 16K, 6K allocation from CEP. This is dividend income, right? And then the remaining $10,000 that also is allocated from AEP, and that's your dividend income. So I have kind of cleared my first installment bucket, where 6,000 of it is coming from CEP and 10,000 of it is coming from AEP. Then if I look at the next bucket, next distribution, 16,000, again 6,000 of this is coming from CEP based on the pro rata basis allocation, and the 8,000, remaining 8,000 is coming from AEP, which is allocated in chronological order. Why only 8,000? 10,000 of the 18 gets allocated to the first installment, and whatever is remaining gets allocated to the second installment, which is the 8,000. Now, obviously, we have some excess distributions here, right? So this excess distribution, this is basically treated as return of capital to the extent of shareholder basis. Any doubts here, guys? In terms of distribution, certain other concepts, if we are distribution property, then the distribution obviously instead of cash as dividend, then the distribution happens at the fair market value of the property, and the corporation will recognize gain as if the property was sold. The dividend income for the shareholder is basically the fair market value of the property distributed. In case the property distribution results in a loss, the C corporation cannot take a deduction. Basically, gains are reported, but losses are disallowed. This is in case of a non-liquidating distribution. When we study about liquidation, even loss, you will see that a distribution of property resulting in losses are allowed. Only in non-liquidating distribution are losses disallowed. Stock dividends, again, something that you studied when we did individuals, non-taxable to the shareholder and allocated on the basis of between the old and the new shares. Stock redemption. This is basically repurchase of the shares by the corporation. Here there are 2 types of redemption. It could be a proportional redemption of stock or a disproportional redemption. The proportional redemption of stock basically results in taxable dividend income to the shareholder, and the shareholder's percentage of ownership after this redemption remains the same. But in terms of disproportionate redemption, the shareholder must treat as if he sold the stock and must recognize gain or loss. Here, the shareholder's ownership percentage will change after this distribution. And when is it generally considered disproportionate? There is a list that's given in your book on page 42. When the redemption is not essentially equivalent to a dividend, or on death of a shareholder, or redemption of stock to pay the estate taxes or expenses, or when there is a partial liquidation of the corporation, then you may have a redemption and a disproportionate redemption of stock, in which case you will have to the shareholder will have to recognize a gain or a loss. And the final topic here, corporate liquidations, the second last rather, liquidations and reorganizations. So we studied about, the life cycle of a corporation until the point of, its inception, the income and deductions and distributions. And finally, we're looking at the liquidation of the corporation. The liquidation is actually like a double taxation event where both the corporation and the shareholders will have to recognize a gain or loss. Now, when does a corporation pay tax? When, say, it sells its property and then distributes to the shareholders. On the sale, it will have to pay tax. Or say, instead of selling the property, it is directly distributing the property to the shareholders. Even then, it is considered as a sale, and the corporation has to pay tax. The shareholders, he will have to treat as if he sold the stock and therefore must pay taxes on capital gains, if any. So that is the double taxation event over here. Both the corporation and the shareholders must pay. And there is a good table in the book which helps understand the difference between liquidating and non-liquidating distribution. Let me look at that. So you can see here, the corporation, if it's a non-liquidating distribution, it is mostly in the form of dividends. That's where they say, ordinary income, or it could be capital gain if you're distributing an appreciated property dividend. In case of a liquidation, it's basically disposition of asset, and depending on the type of the asset and the holding period, you may either have a ordinary income or a capital gain or loss income. Like, for example, if it is an inventory, then you will have ordinary income or loss. But if you're saying selling an investment property, then you would have a capital gain or loss depending on the holding period. Less than 1 year, it is a short-term capital gain, or greater than 1 year holding period, it's long-term capital gain. What about the shareholders? Shareholders, as I said, ordinary income up to and it's called dividend income, or in case of a liquidation, it is treated as a capital gain or loss because they're actually selling the stock. Corporate reorganizations, again, basically what here, again, something going back to a concept that we studied in topic 1, where we are saying that reorganization is generally a non-taxable event, though certain conditions have to be met. There are different types of reorganizations, type A to type B, type A to type G, which I will go through in the PDF. And as I said, it's generally non-taxable, except, say, the shareholders receive a boot in addition to the stock as a result of this reorganization. Then a gain is recognized to the extent of that boot. So let's look at the different types of reorganizations. Okay. So you have type A, which is a merger or a consolidation. Type B is basically where the corporation uses its voting stock, at least 80% of it, to purchase the target corporation. Type C is you use the voting stock to acquire the target corporation's net assets. Type D is where you transfer the assets to acquire at least 80% of the shares of the target corporation. Type E is basically recapitalization, that is, the organization itself changes its capital structure. Like, for example, bondholders exchange old bonds for new bonds or new bonds for stock. So there's just a capital overall within the organization. Type F is a mere change of identity, form, or state of the incorporation. Again, very basic. And type G, transfer of assets of an insolvent corporation. So basically, if a corporation has applied for bankruptcy, the bankruptcy and you will read this when we're doing reg law, the bankruptcy trustee takes hold of or gets control of those corporations' assets, and they may form a new entity just for the sake of distribution to the creditors. So that kind of transfer of assets is not a taxable situation. So this is as far as reorganization is concerned. And finally, when we study about corporations, we also want to know that there are certain small business stock which have some special benefits, I would say. So there's two different categories here, section 1244 and section 1202 stock. What is 1244 stock? This is basically considered as worthless stock. If you're in a situation where basically the corporation is a small business and it has made a lot of losses, the requirement is that it must fit the category of a small business, and it is applicable to first 1 million of stock issuance by domestic corporations, and the shareholder must be an original non-corporate shareholder, which means it cannot be a partnership or another corporation. So in order to take use of this loss, it must be original non-corporate shareholders. And original means they should have purchased it, not received as a gift. So section 1244 stock, what is the benefit here? When that small business is considered worthless, you can take an ordinary loss deduction up to $50,000 or $100,000 for married filing joint, and the remaining is capital loss. It's not gain, but remaining is capital loss. So, I mean, ordinary loss deduction is a big deal, right? You can take this loss deduction against other baskets of income. The remaining would be a capital loss. The other one is a section 1202 stock. This is again a small business stock, where here we are saying the gain on sale is eligible for 100% exclusion of gain, though overall there is a limit, which is basically the greater of 10 times the taxpayer's basis in stock, or 10 million per shareholder. So again, two different types. So it's all relates to only small businesses. You have two different types, when there is a loss and when there is a gain. When there is a loss, it's a section 1244 loss, right? It's called a section 1244 stock, where you can take an ordinary loss up to $50,000 or $100,000 for married filing joint, and the remaining is capital loss. Then there is a gain part. If you have a gain, then it's considered a section 1202 stock, and you can get up to 100% exclusion of gain, which is of course limited to 10% of the taxpayer's basis, or 10 times the taxpayer's basis, or 10 million per shareholder. Certain requirements have to be met. It applies to corporations with less than 50 million in capital. Again, similar to 1244, they must be original non-corporate shareholders, and the stock must have been held for less than 5 years. You will see in your book that there are, other limits, 50%, 75%, 100%. These were all that were there prior to the current, act, the Jobs Act of 2010. Basically, it changed everything and said, okay, right now it's 100% of capital gain exclusion. So that's where that is. Any doubts so far? We'll do a few questions, one or two questions, and then take a break, and then go back to Reg 4. Anybody has any questions so far in C corporations? We've covered everything in terms of the concept. So I'm just going to pick up a few questions for us to discuss. So in your book, guys, go to question number 12. Okay, so question number 12. During 2013, Star Corp reported gross income from operations of $350,000 and operating expenses of $400,000. Stark also received dividend income of $100,000, not included in gross income from operations, from an investment in taxable domestic corporation in which it owns 10% of the stock. Additionally, Stark had a net operating loss carryover from 2012 of $30,000. What is the amount of Stark's NOL for 2013? So how do we compute NOL? So in computing NOL, the prior year carry back or carry forwards are not allowed, right? You're also not allowed any DPAD deductions or any charitable contribution deductions, right? But what you're allowed is DRD. So let's look at this. Folks can unmute and we can discuss the questions. So what is given here? We have a gross income from operations, and this is $350,000, right? What else do we have here that's part of income? Who's going to help me out here? So we're trying to determine the NOL, right, for 2013. What else can we take?
Dividend income.
Dividend income, yes. And this is going to be $100,000, right? And that's it. And then we have operating expenses. So this is $400,000. So what's your taxable income before special deduction, right? So that is $50,000. Now we have to arrive at NOL. So now what do we do after this? Is there any other deduction that we can take? This is obviously income. This is not NOL. So we need to arrive at NOL. What other deductions can we take? Can we take the capital loss carryover from 2012 of $30,000? But Deepa is the only one speaking. I need the others to also participate. Deepa doesn't mean you can unmute. You can still keep yourself unmuted. Not an issue. Who else, guys, has an answer for this? Okay, Devangi is muted. Let me see Devangi.
Hello?
Yeah, Deva.
Yeah, out of it, we have to deduct the dividend received deductions.
Dividend received deduction, okay. And how much is that?
It is 70,000.
70,000. And how did you compute that?
The stock the percentages of stock they are holding in the company is 10%. So if company holding is 10%, up For 0 to 20%, we have to deduct 70% dividend reserve deductions.
Okay, great, great. Now, why are we not taking this on the taxable income? Because the DRD deduction is on the lower of taxable income or the actual dividends received, right? So, why are we not taking it on taxable income, which is lower, $50,000?
Because yeah, DRD deduction will result in loss, so we have to take that.
Yes, exactly. So this is an NOL calculation, and if the DRD deducts in a on actual dividends results in a loss, then we are going to take that, right? So it is minus. So what is your NOL now for 2013?
20,000.
20,000. This kind of concept covers both our NOL learning as well as DRD, right? Let me look at another question here. Go to question number 26 in your books. Okay. So, DAL Corporation was organized and commenced operations in 2001. At December 31st, 2013, DAL had accumulated earnings and profits of 9,000 before dividend declaration and distribution. On December 31st, 2013, DAL distributed cash of $9,000 and a vacant parcel land to Green, DAL's only stockholder. At the date of distribution, land had a basis of $5,000 and fair market value of $40,000. What was Green's taxable income in 2013 from these distributions? So there are two concepts here again that we are going to test. One is, okay, distributions, dividend distributions, where does this come from, A, P or C, P, and two, distribution of appreciated property, which is also dividend, but again, two different new concepts that we're learning here. So let's look at this. All right. So how do we do this calculation? What is it that we need to find out? So we need to find out Green's taxable income, right? So what are the steps that we need to follow here? What are the steps, guys? How is dividend determined? Come on, folks. So Akshay, Tanvi, or Avni, Divyesh, Jigar. There are many guys here. I can read out everybody's names. Karthik. Or Shaili, you can tell me, how is dividend calculated? What is the first step that we need to do?
Dividend here will be 9,000.
Dividend is 9,000?
Yes.
How are you determining it's 9,000?
Because it's DAL distributed cash of rupees 9,000.
Okay, but there is also appreciated property that is being distributed. No? That also has to be considered.
Yes.
Yeah. So what is the first step though? Like if you go back to your book, right? On the page where we're talking about dividend distributions, right? How do we check whether it is dividend or whether it is return of capital or whether it is capital gain distribution? How do we determine that? Anybody who can help Shirley out? How do we determine that? Yeah. So go to your page number 41. What is it? It says taxable dividend income is the higher of CEP or the sum of CEP and AEP, right? That's the first step that we have to do. Yeah. So let's look at that. Do we have AEP here? What is AEP?
9,000.
9,000. Okay. So AEP we have here, which is $9,000. Now let's look at this. Now do we know what is CEP? Is CEP given?
No, but it's not given in the question, but indirectly, CEP is 35,000.
Yes. Why is CEP 35,000? How do you arrive at that?
A difference between the basis and market value of property that they have distributed.
Yeah, great. So now, why are we taking this? So we can see that we talked about it, right? When we, again on the same page, when there is an appreciated property that is being distributed, the corporation must treat as if it sold the property, right? So when it sold the property at its fair market value, so it would compare its basis and the fair market value, and the difference would be its capital gain income for the appreciation, right? So and that capital gain income is a current year income, and therefore it becomes part of CEP, right? So the $35,000 is basically the difference between the tax basis, which is $5,000, and FMV of $40,000. I hope everybody is clear with this concept. At least raise your hands, even if you guys are not speaking, that you've understood this appreciated property dividend and how it goes into the CEP when the distribution takes place. Now, sometimes in the question, it's already included in the CEP, and therefore you don't need to do anything. But in some cases, it may not be included, and you will have to add, like how we are doing it here. Okay. Can folks raise your hand if you understood this concept? We're not going to go on a break if there is not going to be any interaction. Have the others lost their connection or something? Okay, great. I see some hands raised. All right. Couple of hands. Okay. Guys,
Hello?
yeah. Deva.
I have one question.
Yeah.
In non-liquidating dividends, if wherever a property is distributed, how to calculate taxable income if there is also an liability attached to it?
Okay, if there's also liability attached to it, then I think it's given in the book. So look at this example on page R341, where is it there on this page? Actually, I think it is there on page number 43. Actually, okay, go to page.
Yeah, but it is liquidating. Yeah.
Yeah, but the same concept applies. For it's a distribution of assets subject to liability. The liability reduces the amount of distribution to the shareholder. So, like,
okay, so the same rule apply with both.
Exactly, non-liquidating as well. So in case the liability exceeds the fair market value, then obviously the corporation will recognize the gain for the excess. So basically what happens is when you're reducing the distribution by the amount of liability, then whatever the taxable dividend income that the shareholder will have to bear will come down because he's assuming the liability. So same concept applies there.
Okay, thank you.
So coming back to this question, now let's look at the sum of AEP and CEP. So this is $44,000, right? Now let's look at this. What is our distribution? We distributed cash of 9,000 and we distributed property. We'll have to look at the fair market value, which is $40,000. So our total distribution is $49,000, of which we must determine basically what is dividend income. So what is dividend income? Is it the 9,000 or is it the $44,000?
44,000.
44,000. So DI with dividend is $44,000, and then your return of capital, assuming he has sufficient basis, is $9,000. Okay, guys, is it clear? So what we'll do is wrap up this session now for C corporations, and then we'll join back in about 10 minutes, and which is, let's say, right around 9:20, and we'll move on to Reg 4 and look at S corporations. Okay, any doubts till now?
Isn't it return on capital is 5,000?
What did I say? Sorry, yeah.
Thank you.
Okay.
Jayashree, how do we get this 5,000 here?
Okay, so basically my total distribution is 49, right? What's happening? Sorry. My total distribution is $49,000, right? I'm distributing cash of 9K and property worth 40K. So my total distribution is 49, of which we've assumed, we've determined that dividend should be $44,000, which is the greater of AEP or sum of AEP and CP. The remaining, whatever is distributed, is return of capital. Here we are assuming that the shareholder has enough basis and therefore it is return of capital. Okay?
Okay, got it.
Yeah. Okay, guys. So let's take the break and then we'll join in 10 minutes. Okay? Okay, folks, I'm back. Hope everybody is back from their break. All right. So let's move on to Reg 4. Did anybody type any questions? Vivek, you were saying this is your first webinar and you don't have the books. Vivek, can you speak up?
Yeah, hi.
Hi, Vivek. Yeah.
Hi, good morning. Yeah, hi. This is my first webinar and I have not received the study material yet.
When did you join us?
On 7th, I think.
Pardon me?
7th of July.
7th of July. Okay. And you plan to write your reg exams this year?
Yeah,
Okay. Okay. And which city are you from?
Bombay.
Bombay. Okay. So we're right now into Reg 4. And you've opted for self-study or are you a retail student? What's your background? I'm sorry.
No, self-study.
Self-study. Okay.
Self-study, yeah.
Okay. So they've given you access to the videos.
Right,
Okay. You just don't have the textbooks.
right.
Okay. So what I will do is I'll put a word in the office and make sure you receive your textbooks. Again, if you choose to write this year, then this webinar is very much relevant to you. But if you plan to write the reg exam sometime next year, then maybe you should wait until you receive your reg books because that will be tested on the 2018 syllabus. Now the testing is happening on the 2017 syllabus.
Oh.
So I'm not sure if
Okay.
you're actually aware of that.
No, I have not. I will have to then check with the guys there.
Okay.
Hello.
Yeah, actually your voice is a
Okay.
bit low.
Yeah, no, I will have to check with Nida in that case.
Okay, just check with her now because see this is generally the folks who are attending now have basically received their books a while ago. They've probably gone through one round of regulation classes or maybe they have not, but they are for sure they know that they're going to appear for the reg exam this year, and so that's why they're attending these classes. But if you've just joined, I would say that just check with Nida in terms of what your plan is, right? And then this would make more sense. Yeah.
Yeah, thank you.
Yeah. Vaibhav, so I could do all the MCQs in Reg 3, but that is not the objective here. This is slightly works different from the other regular CPA webinars that take place because here we are focusing more on learning the concept because we're not having any live classes for the 2017 syllabus. So that's why I'm doing selective questions and focusing more on the concept. You are free to work the questions out on your own, and if you have any doubts, you can always email me and I can help you with it. Vaibhav, you can speak if you have an issue.
Yeah, okay, I'll do it myself. Can you repeat 3.8 then once again, please?
3.8. Okay.
Yes.
Okay. Corporate liquidations. Yeah, I'm coming to that. So here in corporate liquidations, our aim is to understand what happens in the event of a liquidation, right? The corporation is no longer going to exist. So therefore, it must liquidate all its assets and, distribute to its shareholders. So it can do it in one of two ways. That is, the corporation can sell the property and then distribute cash to the shareholders, or it can directly distribute the property itself to the shareholders. So now, what happens if the corporation sells the property and distributes to the shareholders? The corporation recognizes a gain, obviously, because it has sold the property. The shareholder was also recognize a gain because it is as if he is selling his stock. So whatever distribution is received minus the stock basis, that would be his gain. Another option is where the corporation distributes the property directly to the shareholder. Here too, the corporation will recognize a gain as if it sold the property, right? Which is basically the fair market value minus the property basis. The shareholder will also recognize gain because now instead of cash he's received a property, so it is the fair market value less the stock basis because the stock no longer exists. What I was saying was this table is important in understanding the difference between a non-liquidating and a liquidating distribution. As you can see, in liquidating distribution, it's a double taxation effect. Both the shareholder and the corporation pays taxes. Now let's look at the non-difference here primarily. So if a corporation is making a non-liquidating distribution, then it would recognize ordinary or a capital gain if the non-liquidating distribution is of a property, appreciated property. In case of a liquidating distribution, the corporation would recognize either gain or loss depending on what is it that they make from the sale of the property. If it comes to a shareholder, in case of a non-liquidating distribution, it comes in the form of dividend, which you've seen that when we did corporate E&P, right? When we look at liquidating distributions here, he does not have the stock ownership is diluting, right? So therefore, he will treat as if the stock was sold, and there will be either a capital gain or loss that would be recognized. This is primarily the main part of liquidation, and we also looked at reorganizations where I said this is a non-taxable event. Here too, the corporation is either changing its form. There's a merger or a consolidation, or there's sometimes a mere change in identity, like it's changing its name, form, or state of incorporation. Then in such cases, it is a non-taxable event. And we looked at different types of reorganizations. There is an A, B, C, D, E, F, and G, where you either use the voting stock or the assets to acquire the target corporation, and there's a limit, right? You must at least acquire 80% of the target corporation for it to be treated as a non-taxable reorganization event. Any doubts here?
Jayashri, what does liquidating and non-liquidating mean here?
So over here, you mean? I didn't get your question, Shelley. Hello.
Explain the meaning of non-liquidating and liquidating distribution.
See, liquidating means the company is no longer going to exist, right? Non-liquidating means regular distribution. Like, for example, a company announces that we are going to pay dividends at the rate of $1 per shareholder. That is a non-liquidating distribution. But liquidating is basically when the company is winding up. Okay. Yeah.
Yes.
Vaibhav, I hope I've answered your question. Yeah.
Just one more thing. I couldn't even understand that part 2 of the 3.7 also. If you don't mind, can you repeat in 2 minutes? The corporate distribution.
Okay, part 2 you
so
did
this is different.
Okay.
I couldn't understand accumulated E&P.
Okay, I get that. Okay. So now it's a very simple concept. So whenever a corporation decides to distribute, right? So we need to figure out what is this distribution? Is it dividend income?
This is non-liquidating kind of distribution
this is
we're talking about here.
Exactly. This is the non-liquidating kind. You're right. So we're trying to figure out whether it is dividend income or whether it is return of capital or whether it is excess capital gain distribution. So to figure that out, you're seeing, okay, the first thing you want to see is whether it is dividend income. So how do you determine that? You look at the higher of CEP or the sum of CEP and AEP. So then if it meets one of those criteria, then your distribution is dividend income. Now, if your distribution is in excess of the CEP and AEP, right, then it is non-taxable return of capital to the extent of the shareholders.
Just a sec to interrupt you. This will be at the hands of corporation we're talking about, not
Yes.
at the shareholder level.
No.
Unlike in the other three.
Yes, tell me.
No, I'm sorry. When we were doing the 3.8, we were seeing that non-liquidating distribution at the hands of corporation and shareholder.
Both.
In 3.7, we are only discussing at the hands of corporation, I think.
So okay, so
we're not talking about.
Okay, in 3.7, actually we are talking in the hands of shareholder. Now, what are we saying? It is the earnings. Your CEP is your earnings. So at the hands of corporation, it is taxed as ordinary income. That we know, right? Now it is the distribution. Is when it goes to the shareholder, we are trying to see how is it being distributed. Is it being treated as dividend income or the other items that I just mentioned? So it is at the hands of corporation. It is very simple. It is already income on which they are taxed.
Then why haven't we mentioned in 3.8? We have mentioned only ordinary income in non-liquidating distribution.
Okay, so in 3.8 we are talking about appreciated property dividend. So okay, so two things, right? If the corporation is giving a cash dividend, okay, then this is income on which it has already paid taxes. It's ordinary income. But if it is distributing a property dividend, then it is as if it is selling the property, which we have not accounted for till now, right? In that event, what they are saying is that the corporation also needs to recognize income on the distribution as if it sold its property. So it depends on the type of distribution, whether it is cash or property, in terms of whether the corporation will recognize income on the event of distribution. If it is cash, it's basically something that you've already paid income on, your accumulated income.
So cash can be any kind of gain. It can be capital or ordinary income. Or property will always be ordinary.
No, property will depend on the holding period. Na? If you're distributing a property that you've held for a shorter period of time, then it will be ordinary. If the corporation is distributing something that it is held for more than 1 year, then it will be capital gain.
Yeah, but then it's not mentioned in 3.8. That is all my confusion is all about.
It is given.
So you have just written ordinary income.
No, it is written both ordinary and capital gain. Look at that table. Ordinary or capital gain. You see that?
Ordinary or capital gain for the corporation.
Yes. For the shareholder, it is always dividend income only. Unless, the distribution is in excess of AEP or CEP. As long as you're distributing from the AEP and CEP, it is always dividend income to the shareholder. Only if it is in excess of that, then at the shareholder level, you'll have to think whether it is return of capital or whether it is excess capital gain distribution. But this is a normal scenario. Your table depicts a normal scenario.
Okay. And one last question, ma'am. Do we need to summarize this R330 chart, temporary versus permanent differences?
You want me to summarize?
Or we need to memorize rather?
You don't have to memorize. A lot of these things are something that you come across. I mean, as I said, this topic, if you want to read it again in conjunction with maybe the deferred tax.
So I'm giving my FAR also next month. So I'm really confused about that. What happens in that is there are certain topics which when they throw up in the MCQs, then this is not covered rather. So what should I do about an individual item if it comes?
So that's what I was talking. When you're talking about FAR, deferred taxes, I would say when you're reading that, you also go through this table to see where is it that the book and tax will differ. So like for example, see, let's look at this table. I'll tell you one of these items here. Let's look at that.
And when one confusion is excess of percentage depletion over cost depletion. It's not detectable, so it's creating a temporary difference.
Yes.
So it doesn't create a DTL or DTA. It doesn't create DTL or DTA. Na?
So it will create deferred tax liability is what it will create No, actually, yeah, actually it will have a DTA because you are percentage depletion. You are taking more deduction, right? Whereas in cost depletion, it is lesser deduction. So Vaibhav, let's do one thing now, because this is specific to
Yes.
FAR as well. Maybe we can take this offline because the
I'll
other
take it
students.
offline
Yeah,
with you then.
yeah,
Yes.
that will be better, and then we will cover up
Yes.
the remaining topics. Yeah.
Okay, thank you.
Okay, guys. So let's move on to Reg 4. Okay. So here, just briefly going through the index for Reg 4. Um, So in Reg 4, we are basically looking at, all the other entities that are left out. I mean, we looked at individuals, we looked at C corporations primarily. Now here we're going to look at the other types, which is S corporations, partnerships, estates and trusts, and gift taxation, and tax exempt organizations. And so let's begin that. So, so what is an S corporation? It's a corporation that is like a C corporation but smaller in size. It has certain conditions that need to be met before the share before and the S corporation status can be applied for. And the mnemonic to remember that is that 100 US individuals are common, which basically means that there is a max of 100 shareholders. The US citizens, the shareholders must be US citizen or resident. The shareholders must only be individuals, and certain trusts can also be as shareholders. But by and large, the shareholders must be individuals. And there can be only one type of stock issued, which is basically the common stock. So if an entity meets these criteria, then it can form an S corporation. Again, it is a mini version of a C corp. When we look at the formation, it's similar to that of C corp. Again, the same thing that we went through. The 80% holding test after contribution of cash or property should be received in order to be treated as non-taxable. So those rules remain the same even if it is an S corp. Now, C corporation, you don't need to make any separate elections to say that you are a C corporation. But for S corporation, you need to make an S election, and that election must come from all shareholders. That is, 100% of the shareholders must agree for the S election. And when should it be made? It should be made by the 15th day of the third month. So basically, if it is a calendar year corporation, a 2018 corporation, then it must make that S election by March 15th. So if it makes an election for any time after that, then the election would be effective from the later period. So say I make an election in May, then the S election will be valid only from January 2019, and for 2018 I will have to file as a C corporation. Okay. So the election is very important to determine which year you can claim the S status. Now, the S corporation, unlike a C corporation, is not subject to dual taxation. Why? Because the S corporation only files an information return. It is called a Form 1120S. We'll go through the forms now, right? Who files the taxes then? The shareholders will file the taxes based on their pass-through income. Basically, what the Form 1120S does, it summarizes the ordinary income, and there are certain separately stated items which is reported which is reported on Schedule K, and then it is transferred to the individual shareholders on their K1s in proportion to their holdings. So, for example, I own 50% of an S corp, and say Mr. X owns another 50%. So the S corporation's income will be taxed in proportion to our holdings. So I'll be paying tax on the 50% of the income, and Mr. X would pay tax on the remaining 50%. The due date of an S corporation tax return is 3/15 if it's a calendar year, and this is 6 months extension if it is 6 months extension up to September 2015. What is ordinary income for an S corporation? It is basically its business income less ordinary and necessary business deductions. This goes on page 1 of Form 1120S. I'll show that to you. Separately stated items. These are items which, because again, why are we stating some items separately? Because the tax is paid at the individual shareholder level, and these are items which will receive different treatments at at the shareholder level. Can anybody give me, depending on the tax situation, can anybody give me an example, like what would differ? Like I'll give you one example, right? First, capital gains and losses. So when the income, say there's a $7,000 capital loss that is being transferred for my proportionate share from the S corporation to me, can I take the entire $7,000 loss on my individual tax return? It depends, right? It depends whether, if I say I have capital gain income from other entities, say I have a capital gain of $7,000, then I can absorb the entire $7,000 that's coming from this S corp, and my capital gain loss would be zero. But say this X person also receives $7,000 capital loss. He does not have any other capital gain or a loss item on his individual tax return. Then can he take the entire $7,000 loss? No, he cannot. He can take only up to $3,000, right? We studied about this individuals. The remaining must be carried forward. So the way he treats his $3,000 capital, the $7,000 capital loss is different from the way I treat, and therefore it is separately stated on Schedule K. Can anybody tell me, give me examples of other items on how, why it would, why they need to be separately stated? Yeah. Can somebody tell me about rental income? Why would rental income be separately stated?
Because passive income can only be deducted up to passive losses are only deducted up to passive incomes.
Right, absolutely. So it depends, right? We don't know. If I may have some passive losses which I cannot absorb against other passive income, or an X may have passive losses which will be absorbed by other passive income. So the treatment is completely different. So exactly, and so these are some of the example, which require a separate stating, and which is done on the Schedule K. We'll look at that. Interest and dividends, again, because it depends on dividends has a different tax rate. So there may be some qualified dividends, there may be some other regular ordinary dividends, or interest income is separately stating, because there is a passive there's this interest income expense limitation, deduction limitation. So in relation to that, we're showing this separately. Section 179 deduction, again, going back to your memories, Section 179, there's a dollar limit on that, 500K, but the amount of Section 179 you can take is limited to your business income. If it is in excess of that, then that gets carried forward. So there are these things that you have to think of to see what separates them as a separately stated item. Let's look at the form actually. So Reg 4. Okay, so this is your Form 1120S. To a great extent, it looks like Form 1120, where you have your gross income, total income, this total deductions, ordinary business income versus loss. What you will not see here is the special deductions and the tax portion of it, because it is only an information return. There is a tax payments line here. Again, when we do S corporations, you will see at the very end that there are S corporation also has certain penalty taxes, and that will have to be paid via this 1120S. So that is why you have this tax portion here. This is some other additional information that the IRS needs to know. Look at the Schedule K, right? This is a very important page. The ordinary business income from page 1 comes here, and then all of this is your separately stated items, your rental income, interest, dividends, royalties, short-term, long-term capital gains, Section 179 charity, investment interest, credits, right? Credits also differ of the treatment on individual tax return. Any AMT items, also items affecting the shareholder basis, tax exempt income and non-deductible expenses. When we study basis, you'll understand this better. But Schedule K is a summary of what is going to be transferred to the shareholders. Just like how the Form 1120 has a Schedule L as a balance sheet as per books. Okay, there's also a Schedule M1 reconciling the book to the tax, though this is not very significant because at the S corporation level we're not really paying any taxes. And then there is the Schedule M2. This is your Schedule K1. So again, depending on your percentage of holdings, that is what will your income will get reflected over here. So shareholders details go in here, your percentage of holdings, and then your ordinary income. And look at here, Varun has given, told us here, where does it go on the individual Form 1040. So if it is a ordinary income, it goes on Schedule E, page 2. Net rental real estate income, again this will go on Schedule E, page 1. If it is interest income or ordinary dividends, it would go on Schedule B. Royalties would go on Schedule E. Capital gains and losses on Schedule D. So these are some of the significant items that you want to look at, right? Section 179 deduction, other deductions, and your items affecting shareholder basis, such as your tax exempt income. So this is what, so the corporation, the S corporation will prepare its tax return. It will prepare these individual K1s and will give it to the shareholders. These shareholders, they will use the K1 and file their individual income tax return. Okay. And in reality, a lot of the guys will try to, generally S corporation is a calendar year, so you're okay. But sometimes S corporations are fiscal years. So if an individual does not get a K1 by April 15th, then he may have to file an extension because, the S corporation is on a fiscal year and has not completed his tax return yet. So he will have to apply for an extension and wait for this K1 to come before he files his own tax return. But if they're calendar year, then everything aligns, it's fine. So, any doubts till now? Just give me a second, guys. Page not open. Okay. All right. Moving on. So we'll do this example in the book, which which kind of helps you understand the flow of income. And you can look at your book, but I'll do this here on the slide, so it helps us understand better. So there is this one S corporation with one shareholder, and then we have the following income and deductions. Sales 500,000, COGS is 250,000, salary is 35, rent is $50. There's general administrative expenses of $15. There's capital loss of $40 and charity of $20. So how is this going to flow through on a Form 1120S? And this is important because the same concept applies when we are doing partnerships. So on page 1 of form 1120S, we are going to basically look at, ordinary business income less ordinary deductions, right? So our business income is sales, $500, less COGS, $250, less salary, $35, less rent. Rent is how much? $50, less G&A, which is G&A is again $15. So these are your ordinary and necessary deductions. Should we take capital loss and charity here on page 1 of 1120 S? Okay, will you tell me, should we take on page 1 of 1120S? I know the book doesn't take it, but why is it that we don't take capital loss and charity here?
Because they are separately stated items and they will go to form K1.
They will go to, even this goes to K1, but they go to form K, schedule K. That's what you mean, I think, right? So this ends our ordinary income. So let's look at what our ordinary income is. Ordinary income is basically $150, right? Now let's go to look at, see what goes on form schedule K. So schedule K, as you can see, it begins with ordinary income, right? As we saw on that form. That is 500, no, it's not 500, but we have $150. Yeah. Then what are separately stated items? We have capital loss. That is 40, right?
Charity.
And then we have charity. And that is 20. We don't have any more separately stated items. So now what is our net income? Net income is $90, right? So this is your schedule K. Now, obviously this has to go to the shareholder. Now if these were 100% shareholder, right? Whatever is there on schedule K, 100% would go into his tax return. But say what if this guy were a 10% shareholder? So let's say it's a 10% shareholder. So his schedule K1. So how much of an ordinary income would he get? 50.
50.
Yes. Capital loss? $4, yes. Charity? $2. And net income, this would be $9, right? And where does this go on the tax return? On his form 1040. Now let's look at that. So finally, this is where it closes, right? You start from 1120S and then to the final reporting point, which is the form 1040, from where you pay the taxes. Ordinary income would go on schedule E, page 2. Capital loss would go on schedule D. Charity would go on schedule A, right? Miles takes interest in casual jolly meats, right? And therefore that's the net income. So that's how that is reported, guys. Okay, and in the book it's given that he can use only $3 of losses and 1 is carried forward. It depends upon that taxpayer's situation. If he's able to absorb the entire $4 loss, he can take it. Otherwise, he can take only a max of $3 and the remaining is carried forward. So this understanding of this concept is very important, because I'll not do a similar example for partnership, because the same concept carries forward. Now, so moving on. So whenever we do partnerships or share, S corporations, the important thing here is to understand the basis, whether it is the shareholder or the partner. What is the shareholder's basis made up of? It's made up of his initial contributions. Initial basis is basically your initial contributions, whether it is cash or property, right? Plus any additional contributions, say, they make during the year, plus any separately stated or non-separately stated items, less distributions, less percentage of any non-deductible expenses, or less any losses and deductions, and you would arrive here at your net basis. Now, few points to remember here is that the shareholder's net basis can never go zero. So if the shareholder does get something in excess of his basis, then basically it is capital gain distribution to him, like how we did when we did C corporations. We said if the distribution was in excess of his basis, then he would get capital gain. So generally, your shareholder's basis can never go below zero. Now, if say the corporation incurs losses, now so far when we did this flow of the S corp to the form 1140, we looked at an income situation. Now it is a loss situation. So what happens when there is a loss? Can the shareholder deduct all his losses generated by the S corp? That depends upon the amount at risk the shareholder is. So what is the amount at risk? What is the amount at risk? It is basically the shareholder's net basis and any loans that he has made to the corporation. So if your losses are within this amount, then you can deduct the losses. But the at-risk limitation is something that is applied at the individual shareholder level on the form 1040 to see whether they can take the loss deduction. Now, income is allocated to shareholders on an average daily basis if it is less than 1 year. Just a calculation here, guys. Another important point is fringe benefits. If the corporation, say, gives out any fringe benefits, for example, say it pays a health insurance premium of the shareholders, right? If it is a greater than 2% shareholder, then such fringe benefit is treated as capital gain income, the ordinary income to the shareholder, and is reported on his form W2. The corporation also cannot take a deduction for this. But, and this is what it is. I mean, fringe benefits greater than 2% shareholders taxable to the shareholder. Now, again, just going back to the basis, understand the structure of the basis. Your initial basis consists of cash or property. Sometimes if you're contributing liability, then the corporation assumes the liability as well. You added for income, you added for other contributions during the year, any incomes or losses, and then you subtract for distributions, and then you have your net basis. And an S corporation shareholder basis is something that is computed on an annual basis to make sure that there is no capital gain situation over there. So that in the event of a distribution. Now, let's look at the S Corp earnings and distribution. So now for C Corp, just now we studied elaborately on, where is the C Corp earnings getting accumulated. They had a CEP where all the current year earnings got accumulated. They had an AEP where all the prior year earnings, like retained earnings, got accumulated, right? So we had a CEP and an AEP. Now, when it comes to S corporation, instead of CEP for the current year, we have something known as AAA, which is the accumulated adjustment account. So this AAA will have both the AEP and CEP items. It will have the current year and it will have the prior year accumulations. So that's why it's called accumulated adjustment account. Again, repeating here, C corporations had CEP basket where all the current year income got accumulated, and they had an AEP basket where all the prior year incomes were accumulated. Two different baskets. Here for S corporations, we have only one basket, which is called the accumulated adjustments account, where all the current year earnings and the prior year earnings get accumulated. They also have AEP. And what is AEP? Say the S corporation was a C corporation some time ago, right? And it has any undistributed earnings. Then that undistributed earnings remains in the AEP. So again, not all S corporations will have AEP. These are only corporations which were C corporations before. So let's look at the detail of accumulated adjustment account. It works like retained earnings, which we just saw, right? It is obviously zero at its inception, and it's increased for all separately and non-separately stated items except for tax exempt income and life insurance proceeds on the death of key employee. So anything that the business generates, whether a separately or non-separately stated item, goes into AAA except for tax exempt income and life insurance proceeds on death of key employee. It is also reduced for any losses and distributions, though the distributions cannot reduce the basis below zero, the AAA below zero. So losses can reduce the AAA below zero, but your distribution cannot reduce your AAA below zero. Certain items are not allowed as deduction, and this typically consists of, like, for example, your federal taxes or your life insurance premium when corporation is beneficiary. These are the items that are not allowed as deduction. And distributions from AAA are non-taxable, and this is a very important point. Why is it? Why are distributions from AAA non-taxable? And Naveen Kumar, you have raised your hand. You can talk. You're muted. Okay. Okay, Naveen, I've unmuted you.
Hi.
Hi.
Accumulated earnings profit is we have any losses, C corporation losses?
C corporation losses means there will be no accumulated earnings. This basically consists of your undistributed C corp earnings. If there is losses, then there is no AEP over there.
No AEP, but we can set off in the C corporation profits.
You mean the S corporation profit?
Carry forward.
Yes,
S corporation losses.
Right. I've not come across a situation actually where the AEP is negative, and therefore the there could be a situation. I mean, see, I'll tell you what, right? Distributions from AEP are taxed as dividend income. So in that point, having a positive AEP makes sense. But if there is a negative AEP, I don't think there is a tax implication. But I'm not sure of the answer whether whether it will offset the current AAA. I think they are two different baskets, but it cannot offset the other. You'll just have to forego those losses, I think. But I can look it up. My educated guess is that if AEP were negative, then you simply have to forego that loss. Okay? Yeah.
And the second thing, I have another doubt which is not related to S corporation. Medical exemption 1040. It is a Q3 examination for July 31st. I am going to write exam. So for this exam, applicable 10% or 7.5%?
See, I would use only 7.5%. Because all the 2018 things that are being tested are tested only in 2019, all these changes. So I would go with 7.5%.
Okay.
Yeah.
Okay. So no
So I'm sorry, I would
entry
go with 10%. I'm sorry, currently it is 10%, right? So that's what you would go with. Whatever is the current rule, which is 10%, that's what you would go with. Because from next year, I believe it's changing to 7.5%, right?
Okay, now it is a 10% only.
Now it is 10% only, no?
Okay. Actually, I had a doubt and I raised it to the Miles OTP. There are also some notice on the Miles OTP.
Okay,
There is also saying that 7.5% only, but I raised it through the mail, but they replied it is 7.5% only.
I need to check one second. See, the current rule, what does the book say? I mean, that's what we have to stick by. Now, currently it is 10%, right? As per the book, the 2017 book.
Yeah. As per the 17 book, it is 10% only.
10% only. See, the thing is, right? I'll tell you what. This 7.5% rule that came into existence, I think, as per the Change Jobs Act or whatever, it came up starting 2018. Okay. Now, generally, what they say is that you will be tested on changes 6 months after they have become effective. So the change from 10% to 7.5% became effective in Jan of 2018. But AICPA has said that they will not test any changes until the 2019 exam. So I would go by the 10%, even though this is effective.
Okay.
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 I will just check the OTB to see what it's given over there, but and then I'll get back to you. Maybe I'll make a note here and I'll get back to you on that. But I would take only 10% because AICPA specifically said that all changes will be tested only from 2019.
Okay.
Okay. Yeah.
Thank you.
You're welcome. Okay. So now, any doubts on AAA that anybody has so far? So, okay, so the question that I had to everybody was, why are distributions non-taxable, right? So the distributions are non-taxable because, the tax is already being paid on the earnings at the shareholder level, right? So when accumulations from AAA are distributed to the shareholders, it is non-taxable to them because they've already paid tax on this. Now, but when we look at AEP, which I was just talking about, these are undistributed earnings from the C Corp years. So if a distribution is made out of AEP, then that is taxed as dividend income to the shareholders. So distribution from AAA, non-taxable. Distribution from AEP, taxable as dividend income. Now let's look at the order of distributions. So if an S corporation has AAA, it has AEP, the shareholder has basis, then if the S corporation announces a distribution, says I'm going to distribute say $10,000 to my shareholders, then where will the distribution come from? First, it will come from AAA. Distribution from AAA is non-taxable and the distribution would reduce both the AAA and the shareholder basis. We'll do an example, this will become clear. If the distribution is from AEP, then secondly, after the AAA has been exhausted, then they will go to AEP. The distribution from AEP is taxable as dividend income. It does not affect the shareholder basis. Like the distribution will reduce AEP, but it will not reduce the shareholder basis. Now, after the AEP has been exhausted, then we have the shareholder basis. Any distribution to the extent of basis is non-taxable return of capital, right? Now, after the AAA, AEP and the shareholder basis has become zero, if there is any excess distribution left, then that is treated as taxable capital gain income. So let's do the example from the book and make this clear, right? So example, a calendar year S corporation, page number R413. Let me go to that. A calendar year S corporation had AAA of $500 and AEP of $300 as of 12/31/2010. During 2011, the S Corp had net income of $1,000 and distribution of $2,500 to its sole shareholder Sam on 12/31/2011. Sam had stock basis of 750 at 1/1/2011. So let's do this. So let's say AAA, AEP, and there is a shareholder basis. Okay. Now, so let's look at the opening balances. Okay, how much they had. So this is 1/1/11, right? As of that, the AAA, it had a basis of $500. AEP, we had $300, and the shareholders basis was $750, right? Now there has been activity during the year. The S corporation had net income of $1,000, so let's add that. Now remember, the basket that's accumulating all your income is AAA, right? So that will go in here. And also, assuming this is a 100% shareholder, right? Whatever income that the corporation is making, it will get allocated to the shareholder, right? So he will get the $1,000 as well. Yeah, guys, you can unmute yourself and talk if you have doubts here, because it's again a very important concept. Now, before accounting for the distributions, we want to see what is the basis, right? AEP remains untouched because it is over. The story is over. We just know the balance of this, right? That's what is of concern to us. It does not accumulate the current year earnings, because this is when it was a C Corp, right? C Corp years. This is the current, this is the S Corp life. Now, how much is the total distribution? Distribution here is $2,500. Now, as I said, the order of distribution, right? First from AAA, then AEP, then shareholder basis. Now, distribution to the extent of AAA, right? So less $1,500. Any distribution from AAA will also affect my shareholder basis, so I will also subtract from that. So what am I left with? $300. This will continue, and here, so I still have my AEP, which is $300, and I have my shareholder basis, which is $250. So now my if I've removed $1,500 for my distribution of $2,500, I still have $1,000 left to allocate. So I will first allocate from AEP $300. Now, any distributions from AEP will not affect my shareholder basis, so that will remain 0. So this is again 0. Now this becomes 0. And now this is $250. So now all I am left with, so I had $1,000 remaining after taking out from AAA, of which I have now distributed $300 from AEP. Now remaining $700, of which only $250 is left, right? So this $250 is shareholder basis. Now we have exhausted to 0 here, right? We don't have any more basis left. Now, do we have any more distributions left? What was the total distributions? It is 2,500 of which 1500 came from AAA, 300 came from AEP, 250 came from shareholder basis. How much is left? 450. So now we are distributing in excess of shareholder basis, and therefore that is your capital gain distribution. Is everybody clear with this concept? Please raise your hands if you're clear, or if you're not, then ask me a question. Alright, so I see only one hand raised, which means the others didn't understand. You can raise your hand for even that, or you can speak up. Did you understand? That's the first question. Because basis is very important.
Understand.
Okay. Thanks, Navi. Yeah. So now let's go back and to the PPT. Yeah. So now, so far we studied about the S corporations, its inception, how its income is recorded, what is the pass through to the shareholders, how does it affect their basis, and now comes the winding up of the corporation. So how do you wind up an S corporation? I mean, either you terminate the election or there is a liquidation, like how we did for C Corp. But how do we terminate the election? C corporation had no election, S corporation has election. So there's one more step here in between. You cannot simply liquidate, you are terminating the election. How do you do that? There is a voluntary termination, which means that majority of the shareholders, more than 50% of the shareholders, must vote to terminate. This is unlike inception, S corporation election, which has to be made by 100% of the shareholders. But termination of election, just greater than 50% is enough. It can also be terminated if you fail to be eligible to be a S corporation. That is, you fail one of these. Criteria. 100 US individuals are common. Maybe the number of shareholders has now become 101, or the partners have tried to become an S corporation shareholder, or you've issued different type of stock, or maybe they're not US citizen or resident. Then this terminates the S election. Another technical termination is when they have failed a passive income test for 3 consecutive years. So basically, what is this test? It says more than 25% of the gross receipts are from passive income, and the corporation has AEP. 2 things have to be satisfied. More than 25% of the gross receipts are from passive income, and the corporation has AEP. Now, when is the S election effective? The termination, it can be effective any time during the year, but once an S corporation has lost its S election, then there will be 2 tax returns that have to be filed for that year, and the income must be apportioned between that S corp time period. Say, for example, the S election was terminated in March, so Jan through March, an S corp partial tax return has to be filed. A short year tax return should be filed, and from April to December you will file a C corp. So you will have to apportion your income between these 2 tax returns. Can we re-elect the S status? Yes, it can be elected. It must be made after 5 years from termination. And this is the penalty tax that I was talking about in the beginning. Like C corporations, S corporation also has a penalty tax. And what is that? An important tax here is called the built-in gains tax. So what is this? It is applicable when an S corporation sells asset within 5 years of election of S status. And it's not just any asset, it is an appreciated asset. So if you were a C corporation previously and you made an S election and formed an S corporation, if you sell the assets that you have received from the C corporation within 5 years of the election, and these are appreciated assets, then basically then the S corporation has to pay a built-in gains tax, which is 35% tax paid at the S corporation level. Now, can anybody avoid it? Yes, you can. If you were never a C corp, the sale or distribution of asset occurred 5 years after the S election, or at the time of S election, the fair market value of the property was simply lower than its basis, or the property appreciated in value only after the S corporation was formed. So until then, it didn't do well, right? So that covers our S corporation, guys. Any questions here? And I'll do a couple of questions from here as well. Let me open up this one. Okay. There are only 5 questions actually in S Corp, so we can do it quickly and then wrap up the session. An S Corporation may A. have both common and preferred stocks outstanding, B. have a partnership as a shareholder, C. have a non-resident alien as a shareholder, D. have as many as 100 shareholders. So what's the correct answer?
I think D, as many as 100.
Hi, Deepa. I think there's a lot of background noise on your end. But I think you said D, which is the correct answer. Have as many as 100 shareholders. Number 2, Village Corp, a calendar corporation, began business in 2006. Village made a valid S election on September 5, 2013 with the unanimous consent of its shareholders. The eligibility requirements for S status continued to be met through 2013. On what date did Village status become effective? When is it effective from? The S election?
January 1, 2014.
Yes, exactly, because it was made after the 315 deadline, right? If it's a calendar year, you have to make it by 315. Now, Stahl, an individual, owns 100% of Talon and S Corporation. At the beginning of the year, Stahl's basis in the Talon was $65,000. Talon reported the following items from operations during the current year. Ordinary loss, 10,000, municipal interest income, 6,000, long-term capital gain, 4,000, short-term capital loss is $9,000. What was Stahl's basis in Talon at year end? So, S Corporation shareholder. You go to the number 3. Okay. So we have what is his beginning basis? Beginning basis is $65,000, right? So this is a 100% shareholder. So whatever the corporation makes, it gets assigned to the shareholder. We have municipal interest income. This is $6,000. We have a long-term capital gain, right, which is $4,000. We have short-term capital loss, which is $9,000. Oh, and we also have an ordinary loss, which is $10,000. So what is the ending basis. So $56,000 is his ending basis. Any doubts here? Okay, so let's look at the next question.
Is there any order of deduction?
Yes, there is. So this is the thing, guys. Remember we said that distributions cannot reduce the shareholders' basis below zero. So one thing that you have to account for when you are calculating a shareholders basis is that you can take distributions only when there is basis, right? So when there is a distribution, you have to account for that first. That is, you account for all your income items. Like, let me show you. Say for example, there's a distribution of $50,000. So distribution is $50,000. So what I would do first here is I would account for all my income items, because that is what helps me distribute the $50,000. So my income before distribution, so that would be the sum of all of these. Then I would account for distribution first, because that is something that has already been committed, must be distributed to the shareholder. So I would account for this first. Excuse me. So my net basis here is $25,000. Then from this I would determine whether I can take my losses or not. So basically, so my net basis, if I included a distribution of $50,000, is $6,000. So in essence, what we're trying to see is, we're trying to see if the shareholders' deduction for losses is limited or not, because the distribution has come into the picture. If there is no distribution, then the order really does not matter. But if there is a distribution involved, then you want to make sure that the distributions are accounted for first before you account for any losses. Okay?
Short-term capital loss can only be deducted up to 3,000, no?
So this is the basis. Think about it. Here we are only computing the basis. On the tax return, how you can take, that is limited. But this is your basis calculation. How much do you have in the corporation? For that you take 100% of everything. Okay. We're not talking about what can be taxed or deducted on the tax return. That's a different ball game. This is how much do I have in the corporation. That is what we're calculating here. Okay. Now, let's look at the next question. An S corporation may deduct foreign income taxes, net section 1231 losses, investment interest expense, amortization of organizational expenditure. What can it take? Guys, what can it take? It can take only the amortization of organizational expenditure, right? I have somebody who's raised their hand. Deepika, you have raised your hand. Okay. I've unmuted you. You can speak now. Deepika, if you were planning to speak. Jyoti?
The answer will be D.
Yeah, okay, great. So I mean, because that is what that goes on the first page of 1120S, right? It's an ordinary and necessary business deduction. Yes, you're right. Everything else are separately stated items, and therefore they wouldn't go as a deduction for S corporation. The last question here. Dart Corp, a calendar year Dart Corp is a calendar year corporation, was formed in 2002 and made an S election in 2004 that is still in effect. Its books and records for 2013 reflected the following information. AEP at the beginning of the year $90,000, AAA $50,000, ordinary income is $200,000. Dart Corp is solely owned by Robert, whose basis in Dart stock is $100,000 on Jan 1, 2013. During 2013, Dart distributed $310,000 to Robert. What is the amount of the $310,000 distribution that Robert must report as dividend income for 2013, assuming no special deductions? So let's do the same table that we did, when I did the example from the book. Okay, so let's look at this. So this is, we're looking at 1113 now. Make these numbers here. So on 1113, we had AAA of $50,000. We have AEP of 90,000, and we have Robert's basis. Do we have that? Robert had a basis of $100,000, right? Now, what is the net income during the year? $200,000 was what was earned during the year. So this $200,000 I would also apply to Robert because he's the sole shareholder. So what is my basis before distribution? 250. 250 is my AAA, 90,000 is my AEP, and 300,000 is my shareholders basis. Just give me 1 second, guys.
Shareholders basis is 100,000.
Yes. And then, oh, I put 10,000, is it? Sorry.
Yes.
Okay. There we go. All right. Now, how much did they distribute? They distributed $310,000. So let's see. So first we are going to distribute from AAA. So to the extent of AAA, non-taxable. So then what is my balance? Once again. So I still have 90,000 left in my AEP, and I have $50,000 left in my shareholder basis. Now, Then what am I doing? Then I distribute from my AEP, right? Because I've exhausted my AAA. So that is $90,000. So that doesn't affect the shareholder basis. So that continues to remain at $50,000, right? Then I still have $30,000 as excess distribution. Is that right? Something wrong here? 300,000 to 50. This is 50. So what are they asking? They want us to know what is our dividend. Oh, I think I made a mistake here. Sorry. Now I get it. Okay. So I have
only
we have only $60,000 left. That's right.
for AEP.
Exactly. For AEP, we have only $60,000 left. So that is what would be my dividend income, right? Now I get it. So therefore, what happens is now, we are answering the question here. The question anyway says, they want us to know of the $310,000, how much is dividend income. So this $60,000 is our dividend income. So this is clear. But if we want to go further, right, obviously here the distribution does not exceed the shareholder basis, so we are fine. But for the next year, what do we have? We have $30,000 still left in AEP, and then we have a shareholder basis of $50,000. So if the corporation goes ahead and makes further distributions, then the distribution will first come out of AEP, the $30,000, which will be again taxable as dividend income, and beyond that we would look into the shareholders basis. But as of 2013, yes, $60,000 is the dividend income. Any doubts here, guys? Vaibhav went on mute again. Vaibhav, you are unmute. I think you're self-muted if you had a question. Alan, you are unmuted. Do you have a question?
No, ma'am, it's fine. I understood.
Okay, great. So guys, if you don't have further questions, we'll wrap up today's session. The next class we'll do Reg 4 and Reg 5. Reg 5 is a very small chapter, so we can complete it in that given time period. Okay. Any other questions that you have, you can email it to me. And there was one thing that I wanted to confirm was that whether we're going to take the 10% or the 7.5% on the medical expenses. Let me just look that up and message it to you. But I believe it's continued to be 10%, but I'll check it in any case. Okay.
And any guidelines or advice for exam writers in July?
So for exam writers in July, see, please do your OTB, because as of now, the OTB questions have not been changed for 2019 takers. We will be doing that in the third quarter because they'll be getting ready to write the exams from January. So practice as much as possible in the OTB. If I look at specific chapters, individuals understand the filing statuses and what goes in AGI, itemized deductions, above the line deductions. There are a few numbers I have said that are important to remember, especially the ones that don't change with inflation. You'll have to remember those, but others that are adjusted for inflation, you don't need to. But when I look at these various corporations and the entities, what becomes important, like C Corp, for example, you need to understand Schedule M1. What gets tested widely is the basis part. I mean, whether you're talking about CEP, AEP, or shareholders basis, or AAA over here, or or the shareholders basis as such. And likewise, when you look at partnerships, also basis is a very important concept that gets tested. Estates, trusts, and gifts, again, in terms of what is taxable versus non-taxable, when you look at, an estate tax return. Gift, what is taxable and non-taxable. So some basic details are tested heavily over there. Whether you will be tested on the form as such, will you be asked to fill up a form of an entity? Maybe, maybe not. But usually there would be like a mock form that they would say, assuming this is a Schedule A, what goes on medical expenses, line 1 of Schedule A. So, that that's what is there on the Schedule A. So I would advise that while you're doing your reading, also just go through the form simply to understand what goes where. And that's why I also, when I'm teaching, I take you through the form so you're familiar with it, and don't find it alien when you get this on the tax return. Yeah, that's it. Yeah. Okay. Any specific tip that you're looking for other than this? Okay. Anybody else has questions?
This regulation research questions might be given out of 8 simulations are there. No? How many simulation questions we expect from research and document?
8. Okay. Research questions. You may have 1 or 2 research questions. Max is 2. Document research simulation. You will have 1 of document review simulation. You will have 1 where it will be like a letter format or something, and then you have to go edit the letter for its contents. Or you may have some, a lot of times you will have enhanced simulations where the situation will be given in the first tab. The remaining tabs will have exhibits. So you'll have to look at the exhibits and frame your answers based on those exhibits. So, I mean, the time that you have to allocate for simulations, has to be about 2 hours. 2 hours you would do multiple choice questions, and 50% of the time you would allocate for simulations, because these simulations, whether it is DRS or the one with exhibits, are slightly time consuming. So you want to allocate time to that accordingly.
Okay. And the OTP is sufficient for completing the preparation, or anything we need to go for Wiley books?
No. We don't even give Wiley books. Whatever questions are there in Wiley, we also have, because they're all AICPA released questions. So I don't see it.
So targeting OTP question bank is enough?
Enough, yes.
Thanks.
No problem. Anybody else has doubts? All right, guys. So we'll wrap this up then. And anything that you may have, again, you can always write to me. All right. So see you next week for wrap up of Reg 4 and Reg 5. All right. Thank you. Bye-bye. Bhagya, అయిపోయిందా?